Breaking news, 2.3% GDP. The economy is back this morning, better than ever, having fully shaken off those cold winter weather blues at the start of the year. Real GDP with revisions back to 2012, benchmark revisions they do every year at this time, show the economy is on track for further gains in the second half of the year. The first quarter minus 0.2% pothole on the road to recovery. The harsh cold winter weather effect is gone, and after revision is now plus 0.6%, and the first look at the second quarter is 2.3%. The market is taking the data in stride this morning. That is, it is not really reacting to it. If the Fed is going to go in September with a liftoff, and the data at this point has to tell them not to go, otherwise they are going, then this data is strong enough to assure Fed officials that the outlook continues to improve. In other words, 2.3% real GDP in the second quarter will not stop the Fed in its tracks. A September liftoff is on the table. In fact, 2.3% is strong relative to those leaked Fed economic staff forecasts, showing they think potential growth is just 1.6% this year and 1.7% both in 2016 and in 2017. That's right, today's GDP shows the economy is running faster than potential. Let's look at the sectors of the economy behind the second quarter real GDP 2.3% number. First off, consumers are doing the heavy lifting, with spending rising 2.9% in the second quarter after 1.8% in the first quarter, the same measurement style as 2.3% GDP. Those weaker retail sales numbers that some Fed officials were worried about earlier in the year, forget about it. 2.9% is A-OK. Normal spending on the part of the consumer. Nothing wrong here. What else? Well, exports of goods are back in the plus column. The Fed gave trade a special mention of worry in the press statement yesterday, but exports added 0.7 of the 2.3 GDP points in the second quarter. Maybe world growth is not as much in the dumps as some think. America is still selling it, and its trading partners are buying it. Investment, the Fed thinks companies are not investing enough in America to make the economy grow big and strong in the second half of the year. Well, equipment expenditures were a drag of 0.3 percentage points, matching durable goods orders weakness, but things may turn positive again in the third quarter. Although the caveat is that companies have bought so much equipment the last several years, sometimes we think the investment cycle is over for this expansion from the last recession. Finally, business investment in structures, a drag of less than 0.1, but this is turning around fast with most of the second quarter weakness in oil and gas drilling equipment. We thought inventories were building. Maybe a little inventory correction slowdown problem was brewing out there for the economy, like the one we got in 2006. This is why we thought GDP would be over 3% today, but we got the math wrong. Inventories did not build, did not add to GDP growth at all in the second quarter. The rising inventory sales ratios were strictly a first quarter phenomenon, so we can cross this risk to the continued expansion of the economy off the list. Net real GDP was 2.3% in the second quarter, which is the new normal speed for growth, given the economy's potential is just 1.6%. The longer it runs above potential, the more that risks will build that the economy overheats and causes the Fed to tighten policy too aggressively, having fallen so far behind the curve. Don't like 2.3%? Not good enough? Well, think again. It is the consumer that is in the driver's seat always, and they continue to spend at an even faster rate of 2.9%. In short, there is nothing in today's report that keeps the Fed from raising rates the first time in September. The economy is stronger than you think. Bet on it.